Okay, so thanks very much, Deborah, and to the rest of the Adelaide team for inviting me to speak today. It's certainly a great lineup of companies that they've put together, and certainly timely, as they've said, given especially the Fed comments from yesterday and the recent lift that we've seen in silver prices relative to gold. So let's dive in. I always like to start with a shortcut to the punchline. So spoiler alert, as you may guess, we are very bullish silver and gold here. And more important than that, I think, is the catalyst for the bullishness. And it has really little to do fundamentally with the reaction to the pandemic that we're seeing play out, and more to do with a culmination of a number of long-term macro factors that in our view, we're coming to a head and moving towards another precious metals bull market and price reset, going back to last year, really, in July last year. And our basic thesis, looking at precious metals, gold and silver, is that the financial crisis of 2008 never really ended, and it was inevitable that we would need to keep rates low, keep liquidity pumping, and keep debt growing. While the economic reaction to the pandemic is obviously a major factor and it's a major catalyst in what could be some pretty volatile trading, our long-term view is almost just as bullish heading into 2020 as it is today, and we'll get into that in a minute. So if we do see a major precious metals bull market similar to the ones that we've seen in the early 80s and post-2008, all else equal, we do expect to see silver outperform gold as this new economic normal plays itself out. And given the relative size of the physical markets, potentially dramatically outperform. Similarly, among the producer equities, between the dynamics of the silver mine supply and the relative lack of pure play options, we see strong potential for a scarcity premium to enter into the market and for silver producers and developers to outperform their gold peers over the next several years. Timing is going to be key for that, and we'll try to put some numbers around that as well. So let's start by comparing gold and silver on a few key criteria at a high level. Obviously, there's a strong relationship between the two that we'll get into in some more detail. But fundamentally, in our view, both are money. Both have a long history of being used as money, as stores of value, and both retain that legacy today to varying degrees, depending on the overall investment climate. Through multiple cycles, gold does hold an edge, given the relative scarcity of the element and its ongoing use as a global central bank reserve asset. But we feel that silver's credentials are really impeccable, even as there is a little bit more nuance there. The two key differences in our view are the demand picture, with 50% of silver demand from industrial usage versus about 10% for gold, and the liquidity or scale of the markets, with gold enjoying roughly a 10-to-1 advantage there, both on the physical side, the value, the liquidity, and the size of the equity market. So these two factors really affect how we look at long-term positioning in the metals, as well as the shorter-term trading patterns through bullish markets. So a little more on demand drivers here. Let's just talk about that up front. For both gold and silver, roughly an equal split between jewelry and investment demand, including central bank demand for gold. And for both, there's significant price sensitivity in that balance. In down markets, jewelry tends to pick up the investment slack and provide a floor for prices. And in up markets, investment demand is really the marginal driver of higher prices, typically more than offsetting the more price-sensitive industrial usage of the metals. So the big difference is industrial demand, which you can see a breakdown of here and on the next slide. Roughly 50% of silver demand is for industrial use, primarily electrical applications, and increasingly in photovoltaic use for solar panels. That's a much bigger share than gold at 10%, and outside of periods like the one we believe we're in, it adds pressure or support for silver that gold really isn't subject to. Now, over the last few decades, that industrial demand dynamic has been more of a drag on silver than a support. In particular, the higher silver price coming out of the last cycle led to more substitution than was originally forecast, while lower than expected growth in solar applications has meant that ongoing declines in photography-related demand, as hard as it is to believe today, hasn't really been offset by new uses. So in addition, the economic impacts from the pandemic have led to further reductions in forward expectations for industrial demand, especially in the near term in automotive use. While the fact that the bulk of global silver is produced as a byproduct from base metals mines, which we'll get into a little bit later on as well, could mean a muted supply response in response to declining industrial demand. But all that said, the focus over the next several years, at least in our point of view, has to be on the marginal buyers of silver, and that is investors. And what this chart makes clear in our view from the gray and the red bars is that when industrial and jewelry demand pull back on higher prices, as with gold, the gap has historically been more than made up for by the dramatic increase in marginal investment demand, both physical, the gray bar, and from exchange traded products, which is the red bar on the chart here. So there's a longer discussion to be had about silver's role as an industrial metal, but fundamentally we believe, and I think recent history has shown, that when the chips are down, silver acts like gold, it acts like money, and we expect that relationship to hold true for the foreseeable future. And gold, by virtue of tradition and history, its relative scarcity, certainly the primary precious metals, it holds its value better during bear markets and tends to react first to external factors, but silver catches up fast, especially in a rapidly accelerating price environment, and that's what I think we're on the verge of now. So over the last few years, and even accelerating more recently, the gap between gold and silver has grown, peaking in March at an all-time high ratio over 120 to 1, as gold saw roughly in this period here a 30% move higher in 2019, even prior to the pandemic, while silver basically flatlined. While this ratio and the ratio that it got to was a record, I think the pandemic likely gets credit for the dramatic spike, and a normalized level of 90 to 100, which is where we've retraced to now, is probably more in line with the previous peaks that we've seen over the last 40 to 50 years. So quickly, why does this happen? In our view, it's clear that when investor appetite turns back towards precious metals in times of sustained economic or political crisis and uncertainty, gold comes first. It's easier to trade in volume, more of a pure play on metals as money, and it's held consistently longer term by more investors. Specifically, since the prior peak, as we talked about, we think that the weaker than expected demand picture over the last 5 years was a major headwind, as was the general apathy towards precious metals among generalists, along with the exit from the sector of a number of specialists after prices rolled over in 2013. Gold, conversely, saw strong support from central banks over the last 5 or 6 years, and that helped to support prices in a segment that silver doesn't see the benefit from being not held by central banks as a reserve asset. But as the final bullet mentions, if you time things right, you can see outsized returns, and that's illustrated on my favorite slide in the deck, the one showing some gaudy numbers. Over 6 distinct periods following a spike in the gold to silver ratio, from peak to trough, you can see that silver has massively outperformed gold for a variety of reasons. On average, after those gold to silver ratio peaks, silver shows absolute gains and strong relative gains over the next 2 to 3 years. And even if you exclude the 2 peaks where you saw, around the time that the Hunt brothers tried to corner the market in the early 80s and the financial crisis, the outperformance is still dramatic and obvious. Even in periods when gold was falling, silver continued to outperform. So that said, the strongest returns from silver have been primarily driven by gold gains. And if our thesis is right about the ongoing financial crisis, we look set to see a repeat of conditions seen in the last two entries on that table, in the earlier part of the century and then post-financial crisis. There's no better illustration in our view of this relationship than this chart, which is really meant to show gold's relationship to the growth in the US Federal Reserve's balance sheet from 2008 to 2011. It also clearly shows how silver fell harder than gold on the initial crisis-driven sell-off and then outperformed off the bottom and then dramatically outperforming in the later stages of the rally. The red line here, the red dotted line here, we're about here today. This shows where the balance sheet is today on a relative basis versus the growth in 2008 and what growth could look like given the current stated run rate of Fed asset purchases that was reiterated yesterday. So a real guidance chart, I think, for how to look at how precious metals traded in a very similar macroeconomic environment that we were in not that long ago. So zooming in on the last year, it looks like history repeating. After the spike in March, with silver selling off much harder than gold, the ratio peaked, gold just below 1,500, silver at around 12 bucks. Since then, the ratio has dropped to the mid-90s, gold's up around 15%, but silver is up 50%, as we would have expected and as that historical relationship that we were just talking about would have indicated. If the ratio falls back towards normalized historical levels between 50 and 80 to 1, we could see silver trading in the mid-20s, even at spot gold prices. But a lower ratio is strongly correlated with accelerating gold price appreciation as the moneyness of gold and silver come to the forefront of investor minds, and we'll touch on that as well. That said, things could get pretty wild, as they did during the last bullish cycle for gold, and even more so for silver. You can see on the left-hand side the daily swings that both gold and silver saw on the way to 200 to 300% price appreciation over a couple of years. While volatility has started to pick up on the right-hand side so far in 2020, with a few big up days and some big drawdowns as well. So expect that to be a theme going forward. If the rally continues, some intestinal fortitude is likely going to be required, given the overwhelming amount of news, uncertainty, other markets, and potential for catalyst-driven swings. So about that bullish gold assumption, what's always been frustrating to me is wild price projection, without naming any names in terms of competitors in this space, which is really based on sentiment, momentum, or really nothing at all, which is why we've tried to put some goalposts around where gold should trade relative to primarily the supply of money, using USM2 as a proxy for the long-term rate of increase in global money. And basically, we're strong believers in the relationship between money supply and both gold and silver, base our forecasts on that relationship, subject to multiples informed by the rest of the macro universe. So for gold and for silver, we see the pandemic and the associated global financial machinations is only really exacerbating what was already a positive environment for financial asset inflation, as illustrated on the next couple of slides. So to that point, on the left-hand side here, you can see the relationship between the money supply in blue and the supply of above-ground gold and silver. Leaving aside questions of how much metal is actually trackable and circulating, clearly the pace of fiat monetary expansion has been dramatically outpacing the supply of precious metals at around 1,600% growth versus precious metal stocks growing at about 100% since 1975 and the end of the gold standard, which of course was the entire point of ending the gold standard in the United States. Broadly speaking, from the chart on the right, as you can see on the chart on the right, the price of both gold and silver have more or less tracked this blue line, which is what we look at as the implied fair value of gold as a function of the money supply, which would suggest a price of about $2,500 an ounce for gold today, potentially rising to over $3,000 an ounce. And this is really, and that's on expanded money supply. This is really the key driver of our gold price forecast from which our silver outlook is derived. Just to lay it on a little thicker, I pulled a collection of quotes from Jerome Powell's press conference yesterday. In case there was any confusion about what the Fed was prepared to do or how it saw the next several years unfolding, I think it's safe to say that so far, whatever we've seen is just the start. And as you saw on the chart a few years ago about Fed balance sheet expansion, that's a multi-year process that takes time to play out. I think some frustration about where prices are today aren't really accounting for the fact that this will take some time. We're not in the sixth inning. We're not in the eighth inning. Maybe we're in the first inning, but this still could be the warm-up period, especially for silver, which really hasn't moved at all off of 2019 levels. So you can see these quotes here. I mean, I think they speak for themselves. To be clear, as I mentioned off the top, the setup for another precious metals bull market was being established well before the pandemic. And what we're really seeing now is the exaggeration or acceleration of long-term trends that have been evolving over decades. Global real rates on the left-hand side have been trending down since the 1980s. And so has consumer price inflation, the black line on the right-hand side, despite global central banks' desperate attempts to drive it higher. We think it's hard to imagine at this point a scenario that would see rates start to rise. And of course, the Fed just said that they won't start to rise until at least 2023. And in addition, we don't think that gold or silver need to see consumer price inflation before re-rating, just as they both rose to highs, despite not seeing any material consumer inflation following all of the printing and the expansion of the Fed balance sheet coming out of the 2008 financial crisis. And obviously, debt has accelerated to the point in the US and around the world that there's really no way to credibly talk about reducing deficits, let alone debt, without major structural and social problems. And clearly, this is an issue outside of the scope of this presentation, but one way or another, through inflation, through monetization or reformation of global fiat currency systems, there are very few paths that we can see forward for central bankers and governments that don't lead to a rebasing of the value of financial assets in general and precious metals in particular. And finally, in terms of sentiment on the right-hand side here, one of the best measures that we track to quantify risk and uncertainty politically and economically is based on media analysis and keywords. And this to us indicates that the relative calm of the 1990s as the last major long-term bear market for precious metals is ancient history. And even before the pandemic, numbers on both economic uncertainty and geopolitical risk were spiking. And potentially this could even ratchet up further, unbelievably, into the back half of the year with the 2020 US presidential election and beyond. And in our view, this solidifies the fundamental reason to hold precious metals as a systemic hedge, as a tangible store of value. These factors seem unlikely to dissipate anytime soon. So overall, when we're looking at silver, I think it's clear, and there's a lot more that we could talk about it, but I think it's clear from this sort of high-level overview that silver outperforms gold in bullish cycles, especially on catalyst-driven periods of price resetting, which is what I would argue we're on the verge of today. I think it's safe for the time being to focus on forward-looking investment-driven demand for silver as the primary factor in pricing rather than industrial markets. Those factors certainly do come into play eventually, and on a broad-based silver reset, whenever this cycle is over, the picture might look very different. But I don't think that's a concern at this point if we're right about the macro thesis for a number of years. And finally, we expect silver to play catch-up with the gold trade moving first, and silver with affordability of coin and bar more so than fractional gold, eventually making a big difference as well. So I'll briefly mention the silver equities as the rest of the panel today will cover that in more detail, I'm sure. We've seen, as was mentioned off the top by the Adelaide team, a big rally off the pandemic lows. already, as you can see on the left-hand side, with the larger producers moving faster than the juniors, as signified by the ETFs. But the producer multiples and the resource valuations, which aren't on this slide, but you can see the multiples here, are nowhere close to historical levels or the levels that we saw during the last cycle. So even with the ETFs and royalty companies impacting capital flow at the margins, options that basically didn't exist 10 years ago, as with gold, we still see ample room for stocks to re-rate higher on a sustained rally, providing more leverage, still more leverage to the underlying metal and the broader economic theme. And in terms of mine supply and market options, the nature of silver mining, with the relative dearth of primarily silver deposits, which you can see from this pie here, really limits options for pure play investment, as we touched on closer to the beginning of the presentation. But the sector is healthier than it's been in years after cost cutting, retrenching, and balance sheet repair coming off the prior cycle. More investment in exploration over the last shorter period of time, as well as excuse me. So yeah, that's right. So at this point, more than 90% of both primary silver production as well as byproduct silver production from other mines is profitable even at spot prices, which you can see from the cost curve here. So that provides some support even as we expect fairly dramatic margin expansion and free cash flow growth on the underlying commodity call. So bottom line, we see a strong potential for a scarcity premium in the market among silver explorers, developers, and producers evolving over time. So where could be wrong? Where could we be wrong on any of this? I think the first point on the macro call is that, as Jerome Powell said yesterday, this is really uncharted territory, and a rapid, sustained return to full employment and GDP growth could dampen investment demand and take some of the focus off of systemic risk and on financial inflation-driven gains in broader equity markets. But even if this does happen, we think precious metals still gain, or perhaps not at the pace that we expect in our base case estimates. I mentioned politics before. Obviously, this is a dramatic time globally and in the U.S. With respect to fundamental questions going forward on policy, on politics, and the direction of the country. Without getting into specifics, trade, economic theory, including the potential for MMT, all of these things are being discussed in a way that they really haven't been for some decades and coming to the forefront. I think the bias is to believe that all of these things are probably positive for precious metals and that they introduce more uncertainty, but again, anything is possible. I mentioned also the ETF and the royalty impact on equities. 10 years ago, there was basically no ETF or royalty capital in the sector. It's been a big driver of what's been happening in the gold sector. I don't think it's as big a factor in the silver market. But obviously, with Wheaton Precious in the sector and the ease with which a generalist can invest in silver without necessarily moving further down the list, I think it has impacted silver producers and silver developers at the margins over the last few years. The good news is that, as with the gold market, there's nothing that highlights the desire for leverage like a bullish market. And I think you'll quickly find that investors start to seek alpha and seek value further down the food chain if this bullish market continues. Finally, the Bitcoin and crypto market, and I don't want to go too far on this subject. I think it is possible that at the margin you can see some impact from capital that would have gone to precious metals ending up in crypto hands. But I think there's room for more alternative assets. I don't think that there's necessarily a direct relationship between people who are investing in crypto assets and precious metals. And I think fundamentally there's a difference between the store of value function of precious metals and the hedge that they present versus the more transactional nature, the transactional focus of cryptocurrency in the market as it exists today. Um, let's flip to trading conclusions, and then I'm happy to take any questions if there is time. Simply put, we see fertile macro ground for re-rating of all financial assets and precious metals in particular, given their role as hedges. We see gold as cheap versus the quantum of money and debt in circulation today, let alone whatever is coming down the pipe. And we see silver as cheap versus gold based on the ratio, industrial factors it's subject to, and its track record of leverage to sustain gold strength. Finally, we see silver equities as cheap versus the metal and on a historical multiple basis, while being healthy as a sector, profitable, and set to potentially outperform even gold equities. So thanks again for listening, and I'm happy to take any questions.
Thanks, Michael. That was great. We'll open it up for Q&A. So we do have a couple of minutes if anyone wants to ask a question in the Q&A box below. Maybe we can just talk for a couple of minutes. Obviously, the Fed announcement yesterday seems to be a catalyst for precious metals. Is this the catalyst we were looking for, or do you think there's a lot more to come?
Yeah, I think there's more to come. Fed watching has become maybe the #1 hobby of everyone in markets for the last few years. I don't think that's going to change. I think from a precious metals perspective and from a silver perspective, what you want to see is what Jerome Powell has been saying, that there is effectively no limit to the actions that they can take in order to support the economy. That there's no visibility into when their outlook could change, and that there's no intention to taper from these levels any further any of the programs that they put in place. As long as that stays the baseline, I think that the rally has legs, and I think that there's base case growth from that point. The real things to watch for will be dramatic expansions of the Fed balance sheet, which we're watching every Thursday, and dramatic expansions of the money supply. As well, it's going to increasingly shift from the Fed to fiscal policy and the level of deficit and debt that will need to be incurred for the foreseeable future. It was really 3 or 4 years into the financial crisis that finally the market had an assurance from Ben Bernanke in the taper tantrum in 2013 that things would be normalized. Well, they never really got normalized. Precious metals sold off, but they didn't go back to previous levels. They sat there in a holding pattern for 5 years until the next shoe dropped, the proverbial kicking the can down the road. We came across another can, and Powell and the Fed and governments around the world are kicking it down the road again. And as long as this is the theme, I think we know the playbook a lot better now. And I think we know that absent some other externality, it's not necessarily going to lead to the great normalization that they've been talking about since 2008. And again, I think that's fertile ground for alternatives to fiat, and especially gold and silver.
And I think it's safe to say that one of the questions from the audience was, do you expect to see the silver ETF inflows increase, and will they perform like gold ETFs have over the past 5 months?
Yeah, the major difference is I think they will increase the ETF inflows. The major difference is in looking at the gold space, between ETF and royalty capital investment in the sector, it's a number of about 25%. Coming out of 2013, there was a great demand for safe, consistent, diversified investments in precious metals. The ETFs and the royalty companies really filled that need, and you saw the valuations of the royalty companies absolutely explode. The difference there is that you have about 70 primarily gold-focused constituents of the GDX and the GDXJ, and that's really the value of the ETF. The silver ETF is very different. The biggest ETFs combined, I think, have assets under management of about $1 billion, if I'm not mistaken. And really, once you get past the top 10 holdings, you're getting pretty small cap in a hurry. So it's a very different dynamic. And I think for investors that are focused on silver and want to capture the leverage that I've shown that silver has to both macro and to gold, I think you have to go off ETF. I think you have to go to juniors, to developers, to explorers to look for that alpha versus both the ETF and the broader market in general. I think that was your question, right?
Yeah, yeah, I appreciate that. And if anyone has any other questions, you can feel free to email us and we can send them to Michael at another time.